Good morning. Welcome to Stock Market Today for Friday, March 27th, 2020. And I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. You can find me on Twitter at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today, where you can sign up for a free email where you get a lot of the content for this show. Also gives you daily stock ideas to consider, stress to consider, in your inbox every trading day before the market opens. So U.S. equities were sharply higher on Thursday, near the highs of the day, despite the release of the initial jobless claims, which exceeded 3 million. All sectors were higher, with utilities posting the biggest gain. They were up over 8%. Consumer discretionary added over 4% and was the worst performer on the day. Treasuries were stronger. Dollar was weaker on the major crosses. Gold finished up 1.1%. WTI crude settled down 7.7%. And as we get to the desk this morning, futures are down about 2.5% following that big three-day rally. Asian markets were mixed overnight, and European markets are weaker. Treasuries are mostly stronger across the curve. The dollar is stronger versus the euro, but lagging on the yen cross. Gold is down 1.5%, and WTI crude is down another 2.10%, 2.1% rather, as we get to the early morning Friday trading. So we've had the best three-day rally since 1931. Interesting to me, we've been mapping out the retracement levels. If we assume that Monday was the initial low, and we think it may have been based on our work, we can see that yesterday's rally brought us not quite to, but pretty close to the 38.2% retracement level at 2647. So let's call it 2650. Above that, the 50% retracement level is 2790, and then you're looking at 2932 for a 61.8% retracement level. But we think resistance is going to come into play, or start to come into play right here. RSI is holding bearish ranges. We do have a small bullish divergence in play. What's interesting to me is the fact that the market on the way down sliced through what should have been key support levels. All right, so we want to watch how we react now to what should be resistance levels. Right, if we start to fail at resistance levels after slicing through support levels fairly easily, that'll give you an indication of the likely path forward for the market. Chaikin money flow turns higher with this three-day rally, having broken this downtrend line. So, you know, a little bit of an improvement in the indicators, but still work to do. I think this key retracement level here is going to be important, especially in light of the fact that the futures are down about 2.5% here to get us going on Friday morning. So let's talk about our market in a minute. Well, we've had the best three-day rally since 1931, and you often get these bear market rallies, and they can be fast, they can be large, right? 15, 20%, not out of the question, as we've just seen. And you'll notice, and you'll hear the comparisons, is that the rallies that we're seeing here in the near term are kind of, on par with what we saw in the depths of the Great Depression. SPY nears first key retracement level. We talked about that. Key themes remain risk off despite a rebound from stretched levels. Remember last week, we looked at the key themes and talked about how stretched they were. Well, guess what? They've improved, but they are still stretched. Small cap rebound, but continue to lag the broader market. And futures, as I said, do point to a lower open here today. Turning now to the power bars, slight improvement, actually. I can't believe I'm highlighting these numbers as an improvement, but that's what they are. The Dow added 6% yesterday, no bulls, 6 bears. S&P 500, 5.75% uptick in the number of bulls, 8 bulls to 135 bears. 5.25% for the NASDAQ, slight underperformers, 6 to 21 bulls to bears there. Slight outperformance on the part of small caps, 86 to 487 bulls to bears. Bonds uptick. Utes were the biggest outperformer yesterday. So think about that. We had a huge rally in the market, right? Over 6% for the Dow, 5.75% for the S&P, and it was led by arguably one of the most defensive sectors out there. So just something to keep in mind. According to the Chaikin Power Bar, large cap stocks and small cap stocks are bearish. Major indexes are mixed. Don't have a stock of the day for you today. Actually going to do something different. I'm going to utilize the screening functionality within Chaikin Analytics in light of this big three-day rally that we've had, and what appears to be, at least in the early going today, a stalling out at the first retracement level. I thought it would be instructive to do a screen. So I screened the S&P 500 for stocks that we rate bearish or very bearish, that are below that long-term trend line that we highlight that also exhibit weak money flow and weak relative strength. And I want stocks that are greater than $10 in price. And what you can see is we were waiting for the rating to upgrade on Lyondell Basel. That remains to be seen. But the rest of these stocks, right, are bearish or very bearish, right? 22, call it, stocks that could be candidates. Number one, if you own them, you may want to think about why you own them and if you continue to want to own them. If you do look for bearish opportunities, perhaps a setup may show its face, if these stocks get to or near overbought levels and continue to exhibit the characteristics here. There may be opportunities on the bearish side of the coin if you do trade in that direction. So interesting, some of the names here. All right, kind of interesting to see a name like McCormick on there. Not surprising to see Helmerich and Payne. It's an oil stock. Win, not surprising. Some of the REIT names, you've heard me talk about how you really have to do your work on REITs, right? Here's that Ventas, right? Part of the senior living group of REITs. So it's a pretty diverse mix of stocks, right? You see some retail and Dollar Tree and Ross Stores and Kohl's. So if you want to, add these names to a bearish watch list, I think that makes a lot of sense here in light of all of the volatility that we are seeing in the market currently. Turning now to the sector tracker, and I mean, this is a sight for sore eyes, but I'm going to highlight a theme, right? You've heard me for the past couple of days call this rebound the beat down rebound, right? Seen a lot of the areas of the market that were really beaten down hard on the downturn, seeing a sharp snapback, right? That's why you see energy at the top of the list, industrials, discretionary, right? These are the groups that were really hard hit. You can throw financials in the mix as falling rates or a headwind for that group. Tech materials and REITs are middle of the road, and your kind of defensive areas, the ones that admittedly we've liked, or towards the bottom of the list, right? So you've seen maybe some short covering, some positions squaring after a big downturn, but still to me falls in the camp of the beat down rebound, right? So continue to watch what's going on from a sector rotation standpoint. Continue to look for those trends in relative strength. Remember, this is just the last 5 days, so it's very short term relative strength. We like to look at the bigger picture trends and focus on the areas that are exhibiting the best relative strength as the markets turn lower, because if we do begin to base, arguably those should be the areas of the market that reassert as leadership. Our industry in focus now, aerospace and defense, which over the past 6 months has lagged the S&P 500 by 12.7%. And that power bar ratio, which measures future potential, is really weak, as it is for most of the industry groups. 0 bulls to 8 bears gets it a rank of number 17 of 21 subsectors, having moved down 8 slots over the past weeks. Indicative names there: Maxar, MAXR, very bearish. Aerojet, Rocketdyne, AJRD, very bearish. And AeroVironment, AVAV, also very bearish. So we want to avoid those names. No bullish stocks in this group to speak of. And what's interesting to me is XAR has a bearish ETF power gauge rating, right, and a weak trend below this declining long-term trend line. Now it has snapped back with the rest of the market, but continues to be an underperformer. Money flow mixed to slightly bullish here in the interim. And, it's interesting, we can't even blame Boeing for this, right? Because XAR is roughly an equally weighted basket of the aerospace and defense group. So while Boeing is a holding, it's not an overweight holding, right? It's an equally weighted. So this is, across the board weakness for this group. So just something to keep in mind. I gave you the top holdings here. And you can see, they're all, it's roughly equally weighted. So no one culprit that we can point to, such as, the precipitous decline that we saw in Boeing. Turning now to what's trending, yesterday's S&P 500 movers and shakers. Cisco, SYY, caught an upgrade, sent that stock higher by 17%. CFG, no real news to see that one there, up about 17%. Fifth Third was initiated by on the 24th at D.A. Davidson. Not quite sure what accounts for the big move here other than financials caught a lift. Same with Key Bank. They were assumed neutral on the 24th at D.A. Davidson, getting a little bit of a lift with the banks and the financials. Hewlett Packard, HPQ, nothing company specific to drive trading there. The stock higher by over 16.5%. We'll note that Micron did make some positive comments in and around demand at the enterprise. So that might be a derivative read through for HPQ, Hewlett Packard here. But as I said, nothing company specific to drive that stock higher on the day. On the loser side of the board, Norwegian Cruise Line down 7.37%, as it's not clear that they are going to be able to participate in the stimulus package that was announced this week coming out of Washington. Gap withdrew their guidance following on the heels of Target withdrawing their guidance. Gap down nearly 6%. L Brands, another retail name, down a little over 5.5%. Didn't see anything company specific there, but likely down in sympathy with some of these other names that are withdrawing guidance. I think it's pretty clear that management does not have a ton of visibility on the near-term trends in their business in light of what's going on with shelter in place and coronavirus. Viacom down 5%. A lot of moving parts here, but I will note that they did withdraw their guidance today. And Wynn, there were some gaming revenue numbers out for the industry. Wynn, very bearish stock, down 4.75% on the day. Let's turn now to what we're talking about. We look at our relationships to get a sense for risk appetite in the market. And I told you we were stretched last week. And this is really interesting. Looking at the high yield HYG relative to Treasuries IEF, right? We can see the ratio fell off a cliff. What's really interesting is that the depths of these lows here, the 200-day Z-score. So go back to your college stats classes, right? The 200-day Z-score was down at -6, right? Massively stretched to the downside. Now, even with this rebound, we're still near a -3, so still stretched, just less so. As we look at the RSI for the ratio, right, solidly in bearish ranges, works off an oversold condition, but still in bearish ranges, and that's largely, this ratio trading in line with yields here for the most part. Correlation there between the flight to safety in Treasuries, right? So as yields go down, we would expect this ratio to continue to move lower as Treasuries are outperforming high yield, or, flip it. We're using high yield in the numerator as high yield is underperforming Treasuries. So a bounce from massively stretched positions, but still well below the 200-day moving average, well below the 2018, 2019 lows. So a slight improvement in risk appetite, but certainly still very much in the risk off camp as far as I'm concerned. High beta versus low volatility paints the same picture, and this time I'm overlaying utilities on a relative basis as well. So if we look at SPHB, high beta versus SPLV, low volatility for the S&P 500, clear downtrend below the 200-day moving average, breaks support. Now we've had a rebound here again, massively stretched to the downside late last week. See a rebound here, but the RSI of the ratio still remains in bearish ranges, similar to what we saw for high yield versus Treasuries. And what's interesting to me, as I pointed out, is utilities are holding up on a relative basis. So even with a 3-day rally in the market, utilities have been outperformers. So that to me still speaks to risk off in the marketplace. And in my note today, I go over a lot of the other themes that I look at, right? Whether it's, high yield versus Treasuries and low beta versus high beta, as we're illustrating here. We can talk about small caps, consumer discretionary versus consumer staples, all rebounding from deeply stretched positions. So by no means out of the woods. As far as I'm concerned, to me, it looks like we got really, really oversold, really stretched to the downside, and we're rectifying that a bit. But, for all intents and purposes, can't say we're out of the woods. And even yesterday with the, 6 and 5% rallies in the major indices, high beta actually underperformed low volatility, in line with REITs, Utes rather, utilities outperforming the broader market. And then finally, small caps remain in a weak relative trend. Here's the IWM relative to the S&P 500. Clear downtrend. This is the theme that we've been talking about for some time, right? When we do our relative strength work, I can't remember the last time I wrote on a consistent basis about small caps outperforming large caps. We've fallen off a cliff here with the market sell-off well below the 200-day moving average. RSI firmly in bearish ranges, right? Rebounding from a deeply oversold condition, but still very much in bearish ranges. Still very much a series of lower highs and lower lows if you wanted to draw a trend line on the RSI. That's largely playing out. And you can see the breakdown here right? We broke down out of the range for 2019, actually broke below those 2018 lows, trying to snap back here, but still a lot of work to do. That'll wrap us up. Head over to chaikinanalytics.com/test drive to sign up for that free 14-day trial. Have a great weekend. I'll see you Monday.